Welcome to the Opening Bell Report.
94%.
It is a massive number.
I want you to just sit with that for a second. Plus, 94% in exactly 1 year. We are talking, of course, about Alibaba.
Ticker symbol Balaba, the giant of the East.
So if you are looking at your portfolio today, it's January 24th, 2026, and you see the stock sitting at $173.23, you are probably feeling one of two very intense emotions right now. Pure, unadulterated elation because you bought it a year ago when everyone else was absolutely terrified.
A complete and utter regret, FOMO.
Exactly. And that is the anxiety we need to address right now. Because if you zoom out, Alibaba has nearly doubled in 12 months. And for everyone listening who didn't buy back when it was in the $70 or $80 range, the question screaming in their head is just, did I miss the boat?
That's the classic investor dilemma, right? Is the easy money gone? Or is there still room for this thing to run?
Right. Is this the peak or is this, just base camp for a move to 300? To answer that, we have a fresh investment analysis report that just dropped today.
And the mission here is pretty simple.
We're going to look under the hood of this massive rally. We have to figure out if this $173 price tag is built on hype or if there's actual substance there.
And just to set the stage, because I think context is everything, this report highlights a fundamental shift in the narrative.
Right.
If you rewind to 2024, Alibaba wasn't really a tech investment. It was what the market called a distressed regulatory risk.
Oh, absolutely. I remember that. It was uninvestable. You couldn't touch it without someone telling you the government was about to seize it.
It was a scary stock to own. Today, this report calls it a high-quality compounder. That is a completely different identity.
Wow. That's a shift from toxic waste to blue chip utility in what, basically 2 years?
Exactly. And the market pays very, very differently for those two things.
Okay, let's unpack this. Because you don't get a 94% return in 1 year by accident. The report says this wasn't just market buzz. It outlines 3 specific catalysts.
Right.
I want to go through them, but I'm going to push back a bit too, because I want to make sure we aren't just drinking the Kool-Aid.
Fair enough. Let's stress test it.
Okay, so the first catalyst, and the report says this is the big one, is the fear premium evaporating. Now, to me, that sounds a little psychological. What does that actually mean for the stock price?
So this is fascinating because it accounts for nearly 60% of that price gain. Think back to 2023, 2024. Why was Alibaba at $70?
Like we said, fear.
Right, but specifically, the market was pricing in existential risk, delisting threats from the U.S., unpredictable crackdowns in China. And because of that fear, the market assigned a very low multiple to the stock.
It was trading at what, a PE ratio of just 8 to 10 times?
Yeah, 8 to 10.
Which is incredibly low for a tech giant. I mean, U.S. tech giants trade at 25, 30 times. 8 is like, you're pricing it as if it's a dying newspaper.
Precisely. The market was essentially saying, we don't think these earnings will even exist in 5 years. But fast forward to today, 2026. Did that catastrophe happen?
No, they're still here. The app still works.
Right. Those fears, they subsided. The regulatory environment stabilized. So what happened to the PE ratio? It normalized. It expanded from that 8 to 10 range all the way up to where it sits today at 23.08 times.
So just so I'm clear, the business itself didn't necessarily double in size.
No.
They're not selling twice as much stuff. The market just decided to stop treating them like a toxic asset.
Spot on. The fear premium evaporated. When you stop expecting a company to die, you're willing to pay a normal price for its earnings. That psychological shift is responsible for most of the rally.
That makes sense. It's like a house in a neighborhood that everyone thought was going downhill. Then suddenly people realize it's actually fine. The house hasn't changed, but the price skyrockets because the perception is gone.
That is a perfect analogy. The house is the same, the neighborhood changed.
And here's where I get skeptical. You can't pay the rent with perception. If the vibes are the only reason it went up, I'd be worried. But the report highlights a second catalyst, efficiency over scale.
Yes. This is the operational side of the story.
And I saw a stat in here that really surprised me, and honestly, it looked a little weak. Revenue growth is only up 3.8% year over year. That's barely keeping up with inflation. If this is a growth stock, shouldn't that be higher?
It is modest, you're right. If you're looking for that old school 2015 style explosive growth, this isn't it. But look at the net income line.
Okay, that's up 15.2%.
Right, so revenue is up barely 4%, but profits are up over 15%. That is a massive disconnect. How does that happen?
They stop spending money on things that don't work.
Exactly. This is what we call operating leverage. Management stopped chasing unprofitable growth. For years, the knock on Alibaba was they were trying to do too much, spending billions on side projects just to get bigger top-line numbers.
So they were just buying revenue, essentially.
In a way, yes. This last year, they cut costs in non-core areas brutally. They streamlined. They proved they can squeeze significantly more profit out of the same amount of revenue.
So it's not about getting bigger anymore. It's about getting smarter and more profitable.
And that gives investors confidence that management is focusing on the bottom line, not just empire building.
Okay, so they cut the fat. But that leads us to the third catalyst, which I think is about where the value actually goes: capital allocation.
Right, giving the money back to the shareholders.
This is the hallmark of a mature company. They introduced a dividend 0.61%.
Which I have to say is tiny. Less than 1%. That's not exactly retirement money.
No, it's not a yield play, you're right. But it's symbolic. It's a signal. It says, we have so much cash we can commit to this. But the real story isn't the dividend, it's the buybacks, right? The report says they reduced the total number of shares by 2.1%.
And that is significant.
Walk us through the math on that. Does it actually create value for me, the shareholder?
It absolutely does. Imagine a pizza cut into 8 slices. You own 1 slice. If the company uses its cash to buy back 2 of those slices and just, throws them away.
My slice just got bigger.
Your slice represents a much bigger percentage of the entire company. Your share of the earnings goes up, even if the total earnings of the company didn't change at all.
So my slice of the pie gets bigger without me doing a thing.
Exactly. It's a mature, cash-generating machine focused on returning value to its owners.
Okay, so let's recap the rally. The fear went away, fixing the PE. The company got leaner, and they started paying shareholders. That explains the move from 70 to 173.
It's a textbook turnaround.
But here is where it gets tricky. We are at $173 now. Is it expensive? Did we miss the sale?
That's the valuation check. And honestly, this is where the data is actually pretty reassuring. Well, you asked if buying at 173 means buying at the top. Let's look at that PE ratio again. It's currently 23.08 times.
Which sounds a lot higher than the 8 times it was.
It is higher, for sure.
Yeah.
You have to compare it to its own history. The 5-year historical average PE for Alibaba is 24.5 times.
Oh, interesting.
Yeah.
So even after doubling in price, it's still trading below its own average.
Right. So the report's verdict is that it's arguably still slightly undervalued.
Yeah.
You aren't getting a steal anymore, but you're not paying a crazy premium either. You're paying a fair price.
Okay, that puts it in perspective. But what about the competition? I know investors love to compare it to JD.com. And JD is trading way cheaper, a PE of 9.8. Why shouldn't I just buy JD instead?
It's a valid question. And the report explains this premium for Alibaba really well. It comes down to the business model. Asset heavy versus asset light.
Break that down.
Think about what JD does. They own warehouses, trucks, delivery drivers. It's incredibly capital intensive. Every time they grow, they have to buy more stuff.
Margins must be tight.
Razor thin.
Yeah.
It's hard to scale profits exponentially when your costs grow right alongside your revenue.
And Alibaba.
Alibaba is a platform. But more importantly, Alibaba has Ali Cloud. Software and cloud infrastructure scale so much better than delivery trucks.
Right. Once you build the server farm, adding another client costs almost nothing.
That's the asset-light advantage. The market is willing to pay a premium for that potential. You're paying for software economics, not trucking economics.
That makes a lot of sense. You pay up for the better business. What about PDD Holdings? They own Temu.
PDD is around 18.5 times earnings, so Alibaba is more expensive. But the report views Alibaba as the safer bet now. PDD is seen as more volatile, less stable cash flow. Alibaba is the blue chip of the group.
So summary on valuation is, you're not getting ripped off at 173. You're paying a fair price for quality.
Exactly.
But fair value doesn't make a stock go up. If the fear premium is gone, what drives this thing to $200? If revenue is only growing at 4%, I'm struggling to see the upside.
This is the critical pivot. The report identifies 2 engines for 2026. If the PE stays flat, earnings growth has to drive the price.
Okay, the engine room. What's firing?
Engine number 1, Ali Cloud and AI.
We mentioned the cloud. Is it actually growing?
It is re-accelerated back to double-digit growth. And the driver is specifically enterprise AI demand within China.
Okay, but we hear AI thrown around by every company. Is this real or is it just a buzzword?
In China, it's very real. You have to remember, because of U.S. export restrictions on advanced chips, Chinese companies can't just go out and buy thousands of NVIDIA GPUs easily.
So how do they run their AI models?
They have to rely on cloud providers like Alibaba, who have the infrastructure. So companies in China are using Alibaba's cloud for their AI because they physically can't build it themselves.
So they're selling the picks and shovels for the Chinese AI gold rush.
Correct. And that's very high margin revenue that supports a higher overall stock price, even if e-commerce is slow.
Okay, that's a really strong moat. What's engine number 2?
Engine 2 is what you might call the cash cannon.
I like the sound of that.
You should. We're talking about $22.87 billion in free cash flow.
Over $22 billion. That's a massive pile of money.
And the strategy is to use that cash for aggressive buybacks. The report estimates they can reduce the share count by another 3 to 4% this year.
So even if they don't sell one extra widget, earnings per share goes up automatically.
Exactly. It's financial engineering, but it works. It creates a very powerful floor under the stock price.
Okay, we have the valuation, we have the catalysts. Now we need the strategy. The report gives a BUY rating, but you mentioned there's a but.
There is always a but. The rating is BUY, but the tactical advice is very specific.
Let's break it down for the person who doesn't own any Alibaba yet. They see $173. Do they buy right now?
The report says no. Do not chase the green candle. Don't FOMO in.
So where's the buy zone?
They want you to wait for a retest of the breakout level, which is $170, a dip into the 165 to 170 range. That's the high probability entry point.
Patience pays. Okay, what about the listener who did buy a year ago? They're sitting on nice gains. Should they sell?
The report is emphatic here. Holdy, do not sell.
Why not? If you've made money, why not cash out?
Because the thesis has two phases. Phase 1 was the value re-rating. That was the easy money. That phase is done.
And now?
Now we're in phase 2, the earnings growth phase. This is where the buybacks and cloud growth start to compound. The report has a medium-term target of $190 to $200.
So there's still $20 to $25 of upside per share plus the dividend.
Exactly. Let the compounding do the work. Don't step off the escalator now.
So to wrap this all up, what a journey. We went from a stock people were terrified to touch to a cash flow machine.
It really shows that if you can separate the emotional narrative from the math, there's huge opportunity. The rally was justified by math, not magic.
And for you listening, the key takeaway is patience. If you want in, watch that $170 support line, put an alert on your phone.
And don't panic if it dips. That's your opportunity.
You know, before we sign off, I want to leave you with a thought. We've spent this whole time talking about how Alibaba has matured. It's buying back shares, paying dividends. It feels very stable.
It does, and that raises a really provocative question for me.
What's that?
Are we witnessing the official end of the Wild West era of Chinese tech growth?
Oh, that's interesting.
Think about it. For a decade, it was all about explosive, chaotic growth at any cost. Burn money, capture market share. Now, Alibaba looks a lot like an American utility or, dare I say it, like Apple.
The Apple-ification of Alibaba.
Maybe. High cash flow, massive buybacks, dividends, steady execution. It's boring compared to the old days. But as we've all seen with Apple, boring execution can be incredibly profitable.
Boring is the new exciting.
It just might be.
That is something to chew on. Thanks for listening.
Don't forget to like, share, and subscribe for more.